right, welcome back, everyone. Here we are, episode 11 of the AVID Investor Podcast with me, your host, Josh Adamek. And today we're going to talk about Pittsburgh Real Estate. Why invest in Pittsburgh Real Estate? What are the benefits? What does it have to offer? And, in my opinion, why not? I feel there's no better place. There isn't much better opportunity than owning a bunch of bricks and mortar in the Steel City. And here's why. So as I had mentioned many times, at AVID and AVID Management Group, what we do is we operate under a private equity model. We work one-on-one with private and institutional investors to create and manage portfolios. And the bulk of those portfolios majority of those portfolios are right here in the Steel City, in and around the Pittsburgh market. So, our main focus when we build these portfolios is, not our main focus, but our main property type, our main investment is, what we call regular houses in regular neighborhoods. So we we create and manage portfolios of single family homes in and around the Pittsburgh market. And our go-to is, the 1950s brick ranch. If you live in Pittsburgh, brick ranch and two-story. If you live in Pittsburgh, if you know the Pittsburgh market, we call it grandma's house. So, regular houses, regular neighborhoods. We own a lot of properties, or we invest in a lot of properties in, just the regular houses, regular neighborhoods, in the suburbs, a lot of stuff that's in the suburbs, just outside the city limits. We have properties we invest in, Westview, Ross Township, Bellevue, Avalon. We go out east into Monroeville, Penn Hills, Verona. We're out into West Mifflin, Munhall, those types of neighborhoods. Those are our go-to type of investments. Yes, we have properties in other areas, other parts of the city, but those are just some examples of where we invest, where we build our portfolios. And here's why. Again, our focus is safety and security. While we operate under the private equity model, we have a significant amount of money under management, and a significant amount of property, or a significant amount of money in these partnerships, and a significant number of properties under management. And what we found over the years in creating these portfolios and these partnerships is our investment partners, their main concern, isn't necessarily return on investment or making more money. A lot of our partners and a lot of our investors look at wealth preservation, safety, security, long-term plays, not the quick flips and putting money in and getting money back, and then you gotta find somewhere else to put that money. It's more so wealth preservation. So that's what we do with our private equity partnerships. We focus on safety. We focus on security. It's long-term plays. We set them up so they cash flow. They produce a very solid, predictable rate of return. And then when you own real estate under an equity partnership, you're an owner, you're not a lender, you're an owner. So there's tax benefits that go along with that in owning real estate. Even though when you invest in real estate and you make money, you still get to take depreciation, which is the tax benefits. And there's certain expenses that become tax benefits. You have capital, you have expenses in the properties in the portfolios. Those become deductions, offset some income. So and then capital growth. Capital growth is huge. We invest, the way we buy our properties is typically off market. We buy them at a discount. We do some renovations and we create some value. We create some equity play. So there's capital growth almost instantly in our partnerships. And then, when we look at Pittsburgh Real Estate, Pittsburgh historically has shown slow and steady growth over the years. We don't have these rapid highs. We don't have these crazy lows. Is there fluctuation in the market? Yes, absolutely. But comparatively speaking, Pittsburgh in the Pittsburgh region has shown slow but steady growth over the last several decades in comparison to other markets and other parts of the country that have crazy highs and crazy lows. Yes, right now we're in an up market. We're showing, record prices, things like that. But, historically, slow but steady growth. We love Pittsburgh real estate. We love everything that it has to offer. So let's dive into those points a little bit. When we look at Pittsburgh real estate, there's many ways to invest, or there's many different products and property types to invest in. There's single family homes, there's apartment buildings, there's commercial real estate. There's long-term plays with cash flow. There's short-term plays with flips and builds and new construction. And while at AVID and AVID Management Group, we take part in some land development, some infill new construction, and some new builds. The bulk of our portfolio is long-term plays. As I said, regular houses, regular neighborhoods, that we set them up for the long term. We got our cash flow, we got our tax benefits, we have our equity plays, and again, we have the safety and security. Regular houses, regular neighborhoods. Now, that's our opinion, that's our investment strategy. But let's dive into that in a little more detail. So, a lot of people ask me, well, why don't you just go buy an apartment building? Why don't you go buy a strip mall? Why do you keep doing all these little single family homes? Again, this is our opinion, this is our strategy, but we prefer to build portfolios of single family homes as opposed to, we'd rather go out and buy 20, 30, 50 single family homes as opposed to a 20, 30, 50 unit apartment building. And here's why. The single family homes, we have the ability to buy those off market. So when we're dealing with a homeowner, we're helping that homeowner solve a problem. And when we acquire the property, we're buying them off market. A lot of times we're direct with the seller, the homeowner. And when I say we're helping them solve a problem, it's typically a distressed property that we're buying. It's in need of repairs. They might be behind on some payments, might be facing foreclosure, might be behind on taxes. Well, we have the ability to come in, make a cash offer and make those problems go away. So, we buy a lot of estate type properties. So, fortunately, it's a part of life, where a family maybe has lost a loved one, and now they have this home that what do I do with it? Sometimes the heirs of the estate are, live out of state, live out of town, aren't in the business. Many aren't in the business of real estate, and, just don't want to deal with it, don't want to bother with it, don't know what to do, don't want to spend the money to fix the property up to where they can list it and, sell it on the open market at retail. So, we buy a lot of those types of properties off market. We buy a lot of properties from, burned out landlords or retiring landlords. It's been crazy the last year and a half with all this, COVID and shutdowns and eviction moratoriums and things like that. You have a tenant in there that's non-paying, not able to get them out, not able to deal with it. Well, we've bought, some properties from landlords, that don't have the desire or the ability to deal with those issues. So with buying our single family homes, there's many different ways that we go about acquiring those homes. But more importantly, it's not how we buy them, it's how we manage them and how we direct them over time. So when we go out and we buy 10, 20, 30, 50, single family homes, whatever it is, as opposed to a multi-unit apartment building, we have multiple exit strategies with that home. So, we are, again, our focus is safety and security. We want to buy the property right. We want to make sure that we have equity, that we have cash flow, that we have, the tax benefits and all the benefits of owning real estate. But we also want to know on the back end that we have multiple exit strategies. So we said, what we do is we put these homes in portfolio, we set them up, we put residents in there under a lease option type program. And, our strategy is to put the residents in there, help them, qualify for home ownership and give them an opportunity to own a home where they might not otherwise have that ability to own a home. We do that through our lease option type program. So that's our strategy. But when it comes to, the safety and security aspect, we have multiple exit strategies. If the market continues to rise, we could take those homes, we could sell them on the open market. We can package those homes up and exit them to an institutional investor. If we bought a property for whatever reason that was a, maybe not a good pick or whatever, we missed something, not that it happens often, but we have the ability to sell off, one property or two properties or something like that. Now, given that, and we certainly wouldn't sell that property at a discount or at a loss. We would sell, we're buying with equity plays right out of the gate. So, if we needed to exit a property for whatever reason, we have the ability to exit, and regain the capital, the initial investment, and then put that into a different property. So, you have flexibility and you have the ability to make moves when you have a bunch of single family homes. Now, let's just say, for example, you, rather than buying, 20 single family homes that are scattered site, you went out and bought a 20 unit apartment building. And you come to find out that 20 unit apartment building has some issues. Maybe it was, maybe the, it was a location that you didn't do proper due diligence, and you're not leasing it at the rate you thought, or you for whatever reason you got a bad batch of tenants in that apartment building. Well, that becomes an issue because that all your eggs are in one basket with that apartment building. Now, when we have scattered site single family homes, they're all over the place. It's we're managing individual homes, individual investments. So we have the ability to, if there's an issue with a resident, it's not affecting the whole. It's not affecting the rest of the residents. We have the ability to deal with that. Maybe remove that resident, replace them with someone else, or there's multiple ways that we can handle that, and that's part of the management. Every management company, many management companies deal with issues with residents. It's just a part of the business. So, when it comes to exiting the property, if you own a large apartment building, you're selling based on the NOI and the cap rate. So you're typically, when you buy an apartment building, you're buying from an investor. And if you exit an apartment building, you're selling to an investor. And in my opinion, those are contingent on market cycles. You want to try to buy at a lower price, obviously, increase the income and increase the NOI, create a higher value, and then exit, at a higher price, obviously, if you choose to exit. So it's investor to investor sales. Everybody's looking at the profit and loss and the balance sheets, and it's a financial based transaction. When we're investing in single family homes, we're helping someone solve a problem on the front end. They have a property that they don't have the ability to deal with, or they no longer want to deal with. We're helping them solve a problem, and we're taking that pain away, and we're helping them to move on with their life. And then on the exit on the single family homes, we're helping those residents, solve a problem. They need somewhere to live. we're helping them to qualify for home ownership and to obtain home ownership and obtain the American dream of owning a home. So, with single family homes, we're helping people, solve problems and help on the front end, and we're helping people, own a home, obtain the American dream on the back end. So that's another benefit. Doesn't necessarily affect, that's not a bottom line, what's the ROI, but that's one of the things that we look at with our investment strategy. So regular houses, regular neighborhoods, that's what we invest in the Pittsburgh market. We set it up for the long-term plays. We don't do a lot of these quick flips where we get in, do some, full-blown renovations and then sell it at a higher price. We do, we occasionally will get into a project and do something if the opportunity arises, but not often. Majority of our investments are long-term plays. We acquire the properties, put them in a portfolio, set it up so they cash flow. We got our tax benefits, and we got our long-term plays. We got our capital growth. So if we dive into, ROI, rate of return, if you look at the Pittsburgh market, price points in the Pittsburgh market are amazing compared to other parts of the country. Our median price point right now, it's elevated. I think our median price point is somewhere in the 200K range. Last several years, it's been about 183 has been our median price point. When we buy homes and put them in portfolio, we're typically acquiring the homes for far less than that. We're creating, we do invest in the median price neighborhoods in the Pittsburgh market, but we're typically buying the homes for less than that. We're doing some moderate to sometimes significant renovations, and then minor to significant renovations, and then we're creating that equity play to put those homes in portfolio. But if we talk about price points in comparison to the other parts of the country, in Pittsburgh, you have the ability to buy homes, buy investment type properties that cash flow. That you can buy them right. If you're going to leverage them, if you're going to finance them, you have the ability to put some debt against the properties, and you have the ability to make cash flow, make an ROI from day one, from the time you have that property filled, and occupied. Other parts of the country, price points are so high that rents don't support the price points. So I see investors right now, especially in this market, that are in other parts of the country that are buying properties totally based on speculation. They're buying homes that are $500,000 or whatever, and they're renting for $2,000-$3,000 a month, negative cash flow every month, and they're banking on the equity, the appreciation, the growth, and they'll negative cash flow for a short period of time in anticipation that the market's going to continue to rise, and they'll be able to exit that home for a profit. Now that looks great on paper. Everything looks good on a spreadsheet. But let's just say the market doesn't continue to rise, or let's just say we have a correction and you're in another part of the country, you bought, 10 of these single family homes that negative cash flow, $500 or $1,000 a month. Well, you might have an appetite, or you might have the ability to support that negative cash flow for, 6 months, 12 months, or 2 years, or whatever the case may be. If we have a correction, and not only does that property not continue to rise in value, but it will go down in value. And now you're in a bunch of investments where you're negative cash flowing, they're worth less than you paid for them. And now what do you have to do? What are you going to do? Are you going to let the bank take the property back? Are you going to let them get foreclosed on? Or, are you going to try to weather the storm for another, 2 or 3 years while the market comes back up, and you can maybe exit, at a break even or a slight loss. So, that's what I see in other parts of the country, where in Pittsburgh, we have the ability to buy homes that make sense regardless of market conditions. We're in an up market right now. We still have the ability to buy homes that have equity plays, that have cash flow, that obviously have the tax benefits. I have never once bought a long-term property, cash flow property that had negative cash flow. Why? Because we don't need to do that in the Pittsburgh market. And some of you might say, well, but there's some folks that did really well, in the downturn, in our other parts of the market. Yeah, but just prior to that, there's a lot of people that lost their ass, when the market was up. I'm referring to 2008. So exactly what I'm talking about. People were buying negative cash flow, back in 2007, 2008, and then the market dropped, and a lot of people, went bankrupt, lost their homes, lost their portfolios. It was a bad time for many people, homeowners that not just investors, but homeowners that were buying properties that they couldn't afford, but they were able to qualify for the financing that was available, lost their homes. Investors that were buying, based on speculation, lost their portfolios. Builders that were doing a ton of spec builds, went out of business, went bankrupt. It was crazy in 2008. Did we have some of that in the Pittsburgh market? Yes. But, that was, if you were into the speculative type investing. But what I'm trying to say, what the message that I'm trying to get across is that you don't need to do that in the Pittsburgh market. We have plenty of investment type properties that make sense, regardless of market conditions, that cash flow, that have equity plays, that you can set up for the long term, that you don't have to. Do you have to be aware of market conditions and be aware of market cycles? Yes, absolutely. But you don't have to invest in the speculative type investments. There's plenty of opportunity in the Pittsburgh market where you can focus on safety and security, like we do at AVID Management Group and AVID. So that's my message today. That's my feeling. That's my take on why we invest in Pittsburgh real estate, and why we are so focused on the Pittsburgh market. Again, in my opinion, it can't be beat. So safety, security, long-term plays, offers cash flow, offers a good rate of return. There's tax benefits, and of course, there's capital growth. All of those are found right here in the Pittsburgh market. So thanks for tuning in. That's my message for today.